Hello, everyone. Good afternoon or good morning for West Coast. My name is Chris Purcell, Senior Project Manager with FMS. I have Bonnie Keener from our payroll department with me. We are going to perform this webinar today and to help you understand the Affordable Care Act and what you need to do in order to comply with using the FMS PPACA reporting module. Bonnie's going to go over a lot of the laws and direction from the IRS, and then I'm going to jump in and show you some of the FMS tools that you can use to comply with a lot of the IRS regulations.
Hello everyone, I'm Bonnie. Basically what I'm going to do is go through a very high-level overview of what the ACA is, just to hopefully refresh your memories or make you aware of certain things if you didn't know. Basically the overall high-level ACA requirements, or what the law actually did, was now requires all U.S. citizens to have health insurance. So they put that law into effect, and to make sure that that happens, they also created all of those health, federal and state health benefit exchanges. So that is for the people that do not have health care, can go to the exchanges and get the health care. So in addition to that, what they put in place was it requires the employers to provide or offer health coverage to those employees if they go, and they will be penalized if they go to the health exchange. So basically what they're saying is everybody's got to have health insurance. There's exchanges available for the employees to get the insurance, but what they really want is the employers to offer the insurance to the employees. So basically, let's say what that means to the employees is if you do not have coverage, you're going to have to pay a penalty, and those penalties are going to be gradually put into place. Right now, I think last year was like $300 and some. I think this year is supposed to be like $600 and some. It's going to gradually go up to that $2,085. They are also, because the insurance that has to be offered or that they can get on the exchange is to be affordable. So they can get a premium tax credit for the insurance they choose if they don't make enough money. So if they don't make enough, they can get a credit to oversee that charge. Then what does it mean to employers? Again, what the main goal here is to have all employees will have coverage, and they want the employers to offer that coverage to employees. So if they're not going to offer the coverage, then they're going to charge penalties for that. And basically, if you are a applicable large employer or an ALE, which means that you have 50 or more full-time employees, and you do not make an offer of coverage to your employees, then and one of those employees goes to the health exchange and gets a credit, a premium tax credit, the IRS is going to come back and say, okay, well, we're going to penalize you for every full-time employee up to $2,000 per employee. There's another type of penalty. If you do offer the coverage, but the coverage is not affordable to the employees, so that employee goes to the exchange and gets a premium tax credit, which means they'll pay less. Then you also get a penalty of $3,000 for that employee that's receiving the premium credit. Okay. So what do employers have to do? They're calling it the pay or play penalty, and the reason for that is you really don't have to do anything. You can pay all the penalties and not offer insurance. But if you choose to play, then there's a number of steps that you have to go through, and hopefully you're through that process by right now at this point in time in the year. For 2015, there is transition relief that is being offered. The law states that you're supposed to do the offer of coverage for 50 or more full-time employees and their dependents. For 2015, there is a transition relief that's being offered for over 50 but less than 100 employees. Basically what they're saying with that is that you may be subject to transition relief as far as penalties and things. There's a number of different rules and things that they're offering, but it does not relieve you of not filing the forms and producing the forms to give to your employees. So I thought that was a very important thing to know. I mean, even if you're falling within that 50 to 100 range, you still have to do this reporting. So for tax year 2015, we broke it down into a different number of steps to try to make it a little easier. So we came up with 6 steps, and the first one is to determine if you're an ALE. If you're not an ALE, then none of this actually applies to you. And remember, an ALE is 50 or more full-time employees. Step 2 is to determine if your current health plan offers the minimum value and minimum coverage that the IRS is requiring. Step 3 is to define an appropriate look-back period and measure hours worked and offer insurance that meets minimum essential coverage and is affordable to all full-time employees. Step 4, you got to monitor new employees coming in to identify those that require health care coverage within a maximum 90-day administrative period or wait period. And then step 5 is to compile all of the data required to produce those forms 1095-C or 1095-B to all full-time employees by January 31st of 2015. Step 6 would be to send copies of those forms that you provided to your employees to the IRS by the end of February. So the first step we're going to talk about is determining if you're an ALE. First thing you need to do is you want to go through and determine if you have your average size workforce is 50 or more full-time employees. And basically what you need to keep in mind here is that when we're talking ALE or the ACA, full-time employees are defined as having 30 hours or more average hours per month. So it's not the 40 hours that we're used to thinking of for full-time employees, it's 30 hours now. And then in addition to that, when you're coming up with your 50 or more employees, you have to keep in mind what they're calling full-time equivalent employees. So they've added this new step in. And basically what that's doing is not only is the full-time employees that are averaging over the 30 hours or more a week you have to consider, you also have to consider all your other employees. And you would take their hours and combine them and then divide them out by the 120. And that number would also be considered full-time employees. So they're calling them full-time equivalents. You're using all employees' hours to determine the total of 50 or more employees. So you have to keep that in mind when you're thinking, oh, there's no way I have 50 full-time employees. It's not employees that are over the 40 hours anymore. Now it's considered employees averaging over 30 hours. And in addition to that, you have to consider all your part-time people that are working, because those hours are also taken into effect in this calculation for the ALE. In addition to that, there's also something called a control group or related companies. Any companies that are related have to also be calculated and considered in this determination for the ALE status. So if you have, it's not by FEIN or federal ID numbers or anything like that, it's anyone that has common ownership or has any kind of relation together. All of those companies have to be added together to determine your ALE status. There is some relief for seasonal employees. If you have a lot of seasonal employees that may calculate or figure into your number, there is a calculation here you can go through, and it's basically determining the 50 hours or 50 employees during a 120-day period. So there's a calculation you can go through for seasonal. Okay, so then now what we're going to do is Chris is going to go through and show you how to use our FMS report to determine ALE status.
Basically, the primary tool that we're going to use in all of this is the FMS PPACA average hours report. That's accessed from your menus if you go into payroll and into employee maintenance. We've added a new button here at the bottom, healthcare reform report. This has been on the menus. We released this in late 2013. Hopefully, most of the clients have run this and seen this report because this is the primary report that's going to be used for everything that we're talking about today. Essentially, it's run by pay period date range, so you can enter the date ranges for the reporting period that you want to run it for. You can filter by active employees, inactive only, if that's what you need, or all employees that were paid during that date range. You can exclude salary, include salary if you want. There's filtering for employment statuses. So if you want to do part-time statuses, all statuses, full-time, and then each of the individual ones that we added recently, part-time student, part-time seasonal, part-time with benefits, those kind of things. The ceiling factor is used for affordability calculation, which I'll talk about in a minute. You can filter employees out based on a minimum average hours. So if you're only concerned about employees that are 30 or more average hours, you can put in 30 here to filter out employees. And then you can also filter with the minimum pay periods. So if the employee has been employed for at least 4 pay periods, if you're weekly, you can filter out employees that haven't been employed that long. And then there's methods for the pay period selection. So if you want to, the pay period amount that you put in here, do you want to see employees that are above that amount or below that amount? And then the count method essentially is a way for you to begin the count, the pay period count, on the first full month. So you want to see employees, maybe if they were hired in the middle of the month, you don't even want to start counting their pay periods until the first full month. And then, okay, give me employees that have been here at least 4 pay periods. So it's just ways for you to filter employees from a selection point of view. So when you run this and you run it out to PDF, this is what it looks like. So we're looking at, it's got a lot of information on here, and I'll kind of go through it quickly. This is page broken by store. So if I scroll through each page, I've got a number of employees on each page. So obviously employee number, name, their employment status, their job code if they have one, hourly rate if they're an hourly employee, hire date, rehire, and term dates, the number of pay periods in which they were paid in the reporting date range. So I ran this for the entire year of 2014, and it's telling me how many pay periods each employee worked. And then all the amount fields are stacked. So we've got 2 amounts per column here for each employee. That's why on the left side it looks like each employee is kind of double spaced. It's because over here you've got amount, a top amount, and a bottom amount. And they're related. So first of all, we've got total hours. So the top amount in this column is the total hours. The bottom amount is the average hours over that period. The next column is their healthcare wages. So there's a few setup pieces here that's required behind the scenes so that you can tell your accountant essentially what earnings codes that you want included on this report. If you want to exclude some earnings codes, most clients aren't excluding anything. They're including all wages in the calculation for these methods. So we've got healthcare wages, and then which of those is taxable for federal tax. If any are excluded from federal tax, that's a separate amount. The affordability is basically a calculation that we perform here with the rate of pay, which we'll talk about more in a bit. But the rate of pay calculation essentially takes the rate of pay and multiplies it by 30 hours per week or 60 hours per biweekly, multiplied by the number of pay periods that this report was run for. So this was for, actually 53 pay periods, but by a 52 or 53 week year, times 30 hours per week times the employee's pay rate. That's essentially getting their annual, for this reporting period, which is a year, their affordability, what 30 hours at their rate equals. And then we take that affordability amount and we multiply it by the 9.5% ceiling factor here that we put in originally. This value defaults on the screen, but we multiply it by the ceiling factor. So this is essentially what their affordability ceiling should be for health insurance, no more than 9.5% of their affordability with their rate of pay. This is just one of multiple methods that can be used. Our report uses the rate of pay method. And then on the end, we're looking at deduction information. So essentially the top amount is total insurance, and the bottom amount is average premium. So we just divide the total insurance by the number of pay periods that they were employed to get essentially an average for what they are being charged. So this is what the report essentially looks like when you run it on your own. We can also run this report to Excel. And so when I run it to Excel, it's essentially all the same data, except the amounts aren't stacked. Now they're right next to each other and they're all laid out because, of course, with Excel we've got an unlimited number of space here on the width. In order to get the report into Excel, you will need to contact your accountant, your FMS accountant, to generate the report to Excel and send it to you. Unfortunately, there's no way for us to allow users to download Excel files from the server for security reasons. So you will need to request your FMS accountant to run the report to Excel for you. But essentially, once I have it in Excel, this is the primary tool, as I mentioned before, that I'm going to use for all the steps that Bonnie and I are going to talk about today. Okay, so that was a little background behind this report. I went over all of the fields here. Again, Excel is exactly the same amount. So going back to Bonnie's step 1 to determine ALE status, we're looking for 50 or more full-time employees. And that's really on average over a year, right, Bonnie? Okay, over a year, the 50 or more full-time employees. So in order to calculate full-time employees, we need to look at both employees that are averaging more than 30 hours and then those that are full-time equivalents that are under 30 hours that we have to add up and divide by that 120 that Bonnie was talking about. So I'm going to do that now. This is done for each month during that look-back period, that 1 year look-back period. And then we just average, we get a calculation by month, and then we just add them all up and divide by 12 to get an average over the year, and that's the 50 or more for the ALE status. So let me start with 1 month's worth of data. So this is January that we're looking at here. Okay, I ran the average hours report for January, and so what I want to start with is the average hours. So the first thing I'm going to do is I turned on sort through Excel, just using the sort feature. So the first thing I'm going to do is under the sort, I'm going to sort for greater than 30 average hours. So here's all my employees that are averaging more than 30 hours. Okay, and so we've got 164. Okay, so right away, obviously, I know I'm over the 50 for this month, but for example purposes, I'm going to keep going with the full-time equivalents. So the full-time equivalents is employees that are under 30 hours. So I'm going to do less than 30. Okay, so here's all my employees that are averaging less than 30 hours per pay period, essentially. And of course, you will use 60 in a biweekly. This example that I'm running is a weekly client. So I'm looking for 30 hours per week, so I'm filtering everyone that's lower than 30 hours. But so now that I have the employees, I filtered the employees. Now I really want to concentrate on this hours column, because essentially what we need to do is add up all of these hours and divide by the 120 in order to get full-time equivalents. There's one more piece, although it sounds simple enough in that respect, but there's one more piece that we need to do, and that is limit each individual employee to 120 hours. So employees like down here where you've got more than 120 hours, we need to limit that number to 120. So in order to do that, I'm just going to insert a new column in Excel, and I'm going to do an if statement so that if my hours are greater than 120, then just make it 120. Otherwise, give me the original value. Okay, so if I take that formula and just double-click the bottom right here to drop it down, you can see that these employees here with more than 120 hours are limited now to 120 hours. So that's really our first step, second step after we filter the employees. Then we limit everyone's hours to 120, and then I'm going to go ahead and total them. So I'm going to go down to the bottom here and hit auto sum. Went too far. Oh, let me do that again. So I'm going to auto sum this entire column now. Okay, and I've got 25,000 hours, and I'll just do another formula that takes that value and divides it by 120. So I've got, and you round down. I believe that's correct, Barney? We're rounding down here. So I've got 212 full-time equivalent employees. So obviously we would add the full-time plus the full-time equivalent to get a monthly amount. We do this for each month, and we kind of average out for the entire year. Are we over 50? And if we are, we're an ALE or an applicable large employer. And again, according to the IRS, with the control group and the related companies that Bonnie was talking about earlier, this is done essentially across common ownership. So if you own multiple, EINs or across a common ownership, this essentially needs to be done for all of those EINs kind of added together. So you need to look at the full-time equivalents for all of the EINs in that group and determine this. Are you more than 50? The seasonal employees, the best example that we can give is obviously some sort of a beach grocery store, for example, that 4 months during the year, during summer months, you're flooded with customers and you do a lot more business, and therefore you need a lot more employees. So according to the IRS, if there are 4 or less, so a maximum of 4 months consecutive, keep in mind, consecutive months where you're over 50, and the other 8 months you are under the 50, then you're okay. Then you're essentially exempt from the ALE because you have seasonal employees. So if 8 months out of the year you've got 45 essentially full-time equivalents, and then 4 months of the year you go way up over 100 or so, because of those 4 months you can consider those employees as seasonal. Okay, so that's step 1. Let's move on to step 2.
Okay, step 2 in our process is basically determining if your health coverage meets the requirements of the Affordable Care Act. Basically what that means is that it has to have minimum essential coverage, and it has to be affordable to the employees. Not sure if you're familiar with the offers of coverage on the exchanges, but they have basically 3 types of plans. They have a bronze, silver, and gold. Basically what the ACA requirements are stating that it has to be something very similar to the 60-40 rule or what's offered on the exchange for the bronze plan. So you need to contact your healthcare provider, whoever you work with, to make sure that your health coverage does meet those requirements. Then you also need to make sure that it's affordable, and our report that we generate here that Chris was just showing you works on the rate of pay safe harbor. There's 3 safe harbors that can be used. To be considered affordable, it has to be 9.5% of the employee's household income for the year. And since employers usually don't know the household income, they've put together these safe harbors that you can use to determine whether the insurance is affordable. One is the W-2 safe harbor. That one you might want to be a little leery of because you would have to add in all pre-tax deductions because all wages are considered in the calculation. The next one is the rate of pay safe harbor, and then the federal poverty line safe harbor. So you want, Chris is going to show you how to use the report to determine whether you can consider your insurance affordable.
Thanks, Bonnie. I kind of went over this while I was talking about the various fields that we've got in the average hours report. It's essentially these 2 columns here, affordability and affordability ceiling. So again, the FMS report is using the rate of pay safe harbor. So what we're doing is this affordability calculation here is their rate of pay multiplied by the hours per pay period, either 30 or 60, multiplied by the pay periods that you're running the report for. So you're essentially getting an affordability for the reporting range that you're running. And then on the next column, we're taking the affordability and calculating the ceiling. The maximum essentially that you could charge for health insurance is that 9.5% of the rate of pay safe harbor. So that's what this next column does. It just simply takes 9.5% of the affordability. And the 2 columns on the end is kind of for convenience, but we kind of do the best we can. The problem is, of course, we don't necessarily know which plans, which deductions are self-only, which are, employee and spouse, which are employee, spouse, and dependents, that kind of thing. So this can be kind of skewed. But essentially what we can do here is we can take out, for example, anyone without any insurance, and we can compare the affordability. With a formula, I can take affordability minus the total insurance, and essentially, theoretically, there should be some money left over to making that affordable. So, employees with negatives here are going to be ones that we may want to look at. Again, this might be the plan that the employee might have is a more expensive plan. It's not the self-only plan. It could be an employee, spouse, and 5 children, let's say, for example. We also cannot calculate salary employees because we don't have an hourly rate. So we can't calculate affordability using the rate of pay safe harbor if we don't have the hourly rate stored in the system. So if it's there, we'll use it. But if it's not, you're going to get some skewed results here on this formula that I'm talking about. So essentially, these 2 columns is what you're going to use on step 2 to calculate affordability.
Okay, so up to this point, we're up to step 3. Step 1 was we determined whether we are ALE. And in that ALE calculation, we determined how many full-time, which are the less than 30 hours averaging a month. Then we went into step 2 and determined whether you had full coverage that meets minimum essential coverage and minimum value. Now we're into step 3. Basically, step 3 means we have to define all of our measurement periods and determine who we now have to make offers to. That word offer is very important. It's not you don't have to make employees have coverage. All you have to do is give them an offer of the coverage. So the IRS now wants you to go in and determine all of these measurement periods so that you can figure out who you need to make an offer of coverage to, which is those employees averaging over the 30 hours a month, 30 hours a week, and then maintain that. So the first one we're going to talk about is the measurement period. And basically what the measurement period is where you're finding out who has worked for you and has worked over that 30-hour threshold and requires an offer of coverage. And the way I like to look at it, and in my example here, is that basically what you're doing is you're doing your measurement period, which is usually for 12 months, and it should be of the prior year. So for 2015, you should be looking at 2014 hours, and it's dependent on what's good for you or where your plan starts or health plan coverage starts. But in my example here, I used October 1st of 2013 through September 30th of 2014 as my measurement period. So what I'm going to do there is find out all of the employees that averaged over the 30 hours a week for during that whole 12-month period. Those employees are the ones that are required to now have an offer during my new plan year. So the next one, the administrative period, is basically the time that you have to do all these calculations, get all the offers out to employees and have them sign all the documentation and all of that information. So it's similar to open enrollment. Then the stability period is just when your plan year is in effect. So in my example here, my administrative period, I took 90 days. You can have up to 90 days. You don't have to use the full 90 days. You could do it however time period you want. You just can't make it longer than that 90 days. For the measurement period, it can be 3 to 12 months. Cannot be less than 3 months. The stability period has to be at least as long as the measurement period. So in other words, if you're using a 12-month measurement period, then your health plan should be 12 months. If you have a health plan that's only 6 months, then you can make that measurement period 6 months. So it's up to you however you want to handle that. So the stability period is from, in my example here, from January 1st of 2015 through December of 2015. During that time is when everybody should have been offered health coverage as of January 15th. So, and they would be covered up through December 31st. What I'd also like to point out while we're on this topic is that even though right now we're concentrating on trying to get 2015 completed, you should also be going through this exercise for 2016 of next year. Depending on when your health plans start and open enrollment and all that kind of thing, you can adjust these dates to meet your requirements. Okay. Oh, I had an example. Okay, here's an example of some of the periods. They're pretty much all the same. So you would see that for this example that I had for 2015, we also need to move on to 2016 so that if your plan year does start January 1st, you should be making offers and measuring all of the data for 2015 to make your offers in 2016, as well as trying to gather up all of the data that we're going to need for the reporting at the end of this year.
Okay, so step 3, as far as the FMS tools are concerned, it's not. There's not a whole lot to it. Obviously, we don't have tools in order to make the determinations for you. You obviously will determine the measurement periods, the length of all the periods, the measurement period, administrative period, and the stability period. So I really want to go to the measurement period and just quickly talk about the how to use the look-back period. So again, I'm still on the 2014 version of this report that I ran for the entire year. And really, it's all about the average hours for those employees. So the first thing I would do, again, is filter with anyone that's greater than or equal to 30 employees. And then obviously, I also want to filter out anyone that's been terminated in prior years. So I can filter those employees out. So this kind of gives me a starting point for 2015. Says, okay, here's a list of employees that are averaging more than 30. They're still active as of January 1st, 2015. that I would essentially be measuring, and therefore would require an offer. Okay, so let's move on to step 4.
Step 4 is basically just that initial measurement period. Basically what you're going to do here is just monitor your new employees. As new employees come in, you need to monitor them on a monthly basis to see if they're going over that 30-hour threshold and may require an offer of coverage within that 90-day window.
So from the Excel report, we can do that using one of the monthly versions of the report that I ran, where we can just take January, for example, and just filter the average hours here. However, we can also use the PDF version of the report when we go back to running the report. If I just run it for 1 month, as Bonnie's saying, you need to run this essentially monthly. You should be running this report monthly. I can filter for the 30 average hours here. So now what I can look for is essentially, okay, who is a new hire in January? I can run this for January, and I can look at employees with the hire date in January 2015, and then I can look at their average hours. So you can use the report here to filter their average hours, and then look at the PDF, or of course from Excel, you can filter on the average hours column, and then also filter on the hire date to look for employees hired in that month. Step 5.
Okay, step 5 is basically providing at the end of the year, you have to provide to your employees the forms 1095-C or 1095-B. So up to this point for 2015, hopefully we are gathering all of that data on a monthly basis as to whether who was offered coverage, and if not, why. And Chris is going to go through some of that with the codes and everything that's going to be used to be put in the system. That's it.
Step 5 is really the big kahuna. It's where all the data comes to a head, and it's where we're essentially reporting to the employees the offering coverage by month using the 1095-C. FMS, our reporting module, is essentially just a data repository. So we do require the client to give us the data so that we can put it onto the report. The FMS PPACA reporting module is not calculating the offering coverage by month for every employee. That has to be done by the client and then entered into the FMS reporting module. There's 2 ways to get the information into the reporting module. I'm going to talk about both of them. Let me start, before I do that, let me start with the 1095 form so we can review this and understand what exactly the ultimate goal. This is the ultimate goal, one of these forms for every employee. Well, let me clarify that. Every full-time employee, for clients that are not self-insured or self-funded with their health insurance. For clients that are self-funded or self-insured, kind of synonymous terms there, it is required for full-time employees as well as part-time employees that are enrolled in the coverage. Self-insured clients will also be required to complete Part 3, the covered individuals. So self-insured have a little bit more work to do. They have to do, the part-timers that are enrolled have to get these forms, as well as for all the employees that get this form, they need to do the covered individuals. One quick reminder on the covered individuals, this also includes the employee. You will put the employee here as well as any other covered individuals, spouse and dependents, down under this section. The majority of the data revolves around this Part 3. This is, obviously, we know the employee name, the social, their address. We know the employer name, EIN, and all that information. You will be prompted for this plan start month. That's easy enough. But all the data and all the work and the heavy lifting comes from these 3 lines here, line 14, 15, and 16. And line 14 is the offer of coverage. That's the code, the IRS code, that they have a dozen of them, to tell them if the employee is receiving an offer, what type of an offer they are receiving for each month. The line 15 is the employee share of the lowest cost monthly premium for self-only minimum value coverage. So essentially, this is the bronze plan. What's the employee share of the bronze plan for self-only coverage? This box is only required if line 14 is 1A, 1C, 1D, or 1E. It's not required all the time, essentially. And then line 16 is the safe harbor codes. So this is another dozen codes that employers can essentially say, I didn't offer the employee coverage, but this is why. You know, they either met this or they, you know, it's the safe harbor. There's a lot of different codes that you can kind of qualify essentially why you did or did not offer coverage to employees. So clients need to calculate these codes for their employees. Obviously, you need to become familiar with the codes. The best resource is obviously the IRS. I know a lot of times it can get confusing, but this document here is definitely the Bible for these forms. The 1094 is just the submittal, so that's just one form per EIN. That's pretty straightforward, and we're not going to talk a whole lot about this right now because we're mostly talking about the 1095. What the majority of the work revolves around the 1095C that goes to the employees. This document from the IRS, it's on the IRS website. If you just search for this, instructions for 1095, does give you a lot of information as to what the codes are and how to calculate them. So if I jump down into the 1095, here we are. Here it is for, you know, here's the line 14, and here's all the codes and an explanation of all the codes. Unfortunately, FMS really can't help you in determining which of these codes to use in different scenarios. That's going to have to come from other resources, whether it's legal counsel or your health insurance provider, or we'll talk about contact information from my concierge, our partner, my HR concierge, our partner in assisting clients with this information, or of course, you know, contacting the IRS. What clients need to do first before we start talking about the FMS reporting module is determining which of these codes you're going to use. When we're talking about offers of coverage, most of the time you're offering the same thing to all your employees. You're not necessarily offering, you know, 1C type to some group of employees and 1D to another group, and that's not impossible. I'm sure some clients say, well, we do that, but majority of the time you're offering the same amount, the same offer to all your employees, same type of coverage, and so really what you're trying to do is group employees together so that we can, you know, assign these codes to them and then put that information into the FMS reporting module. So again, we can essentially, we need to look at these and determine which ones we're going to use and then kind of write rules for them. Okay, if we're going to do 1A, the qualifying offer method, who got a qualifying offer? Well, we can start with our open enrollment, and then we can look at, you know, new hires over each month. I'll talk about that a little bit more in detail. We pick which of these codes we're going to use, we assign rules to them, and then we use the FMS tools in order to essentially gather the employees in that group and assign those codes to them. So I'll perform a few exercises, demonstrations of that. But this information, these two steps here, determining which codes to use and what the rules are to apply, have to be done outside of the FMS module. Okay, so all that said, let's talk about how to get the data into FMS before we start determining or how to calculate the data. Two methods. Either we're keying it in directly into the application, or we are putting it into a spreadsheet that your FMS accountant, you can send to them, and they can upload or import the data from a spreadsheet into the reporting module. So let me go over the data entry method first. So if you've noticed, since I think it was Q1 when we released the health insurance reporting, or it might have been Q4 of 2014 is when we released the health insurance reporting module. And that's this new button here on the OIS menu. You've got health insurance reporting. And really we're just looking at two main factors here. We've got the employee offer and coverage, that's the data itself, and then we have essentially a report that just tells you what we have in the system. It's going to tell you by month, it's very similar to the 1095, what offer and coverage codes we have for every employee. So that's kind of like a reconciliation report. I'll show you an example of that in a minute. So when I go into the employee offer and coverage, everything is organized by client and by year. So the first thing you're going to be prompted for is the year in which you want to work with, okay, and it's going to default to the current year. And then we're just, it comes up with a very standard list of employees, okay. So we can, and right here it's telling me what, if I have any data for the employees. So the E is employee and the I is covered individuals. So in the offer and coverage and the covered individuals are two separate data tables. So I can essentially work with them independently. So if I highlight an employee and go into work with employee offer and coverage, I can look at the offer and coverage records that I've already keyed in here, okay? So the data that we're looking for is essentially a begin month, end month, and then the line 14, 15, and 16 codes, and then a full-time indicator. And the full-time indicator is required because we have to know by month if the employee was full-time. For the 1094C, the transmittal form does require a count of full-time employees by month. So that's where we're going to this field in order to calculate that value. So if I go in and edit or add one of these records, you can see I can key in any of these, or I can prompt for a list on the 14 and 16, and we've got very simple descriptions of each code in here. So I will just key in the information, hit OK to save it. So you can see with the begin and end months, I can do a range of months if all of these values on towards the right remain the same through that period. If any of these values, 14, 15, 16, or the full-time indicator, change, then I need to create a new record for that date range, or the month range. So here, 1H is the employee is not employed. Excuse me, the 1H is no offer of coverage. 2A means they're not employed. So essentially, this employee was terminated in the middle of the year, sometime in June, and therefore at the end, this example, the second half of the year, there was no offer of coverage. So essentially, this is going to print on the 1095. It's going to print 1A, 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 all the way through June, and then July it's going to start printing 1H, 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 okay, and so on. And we're going to do the same thing for the box 16 codes with what we have here. And then if we put anything for the employee share on line 15, that will print in here as well. So regarding printing, let me just talk about that really quickly before we go on to the spreadsheet. Essentially, using the FMS module, we will print these for you just like we print your W-2s. So it's at the same time, getting these into the employee's hands is the same time as the W-2s. Am I correct, Bonnie? At the end of January. The end of January 2016, you need to have these forms into the employee's hands. So essentially, we need to have this data ready to go. And so that we can print the forms. They will be in a sealer format, very similar to W-2, so that they can be immediately mailed out. They'll just need postage, and they can be mailed out. We can mail them from here if you want to pay postage as well. I believe we're offering that. But essentially, once we have all the data at the end of the year, FMS will print these for you. We'll seal them just like the W-2s, and then we'll ship you all of the forms ready to be filed. and we'll also generate the electronic file that's required to go to the IRS to give them all that information as well. Okay, so just wanted to talk about that real quick while it's on top of my head. So we're talking about printing the forms. So this is obviously a lot of work to key in all of this for every employee. So that's, of course, why we created the spreadsheet method. The spreadsheet method is very similar to the total cost of healthcare spreadsheet import that you should be familiar with last year. I think even 2013, or at least last year, we had to print the total cost of healthcare on the employee's W-2. What was the employee plus employer share of the employee's healthcare for the year? And most clients would send that information to us in a spreadsheet, and then we import it, that your FMS accountants will import it into the system. It's a very similar kind of thought process using this scenario. So what the spreadsheet looks like is it's the same exact fields as columns here. So we've got including the client number and the year, the employee number. This is an identification number. This can be either the employee number or the Social Security number, and we can reference the employee record using either of those values. At the begin month, the end month, blocks 14, 15, 16, and then the full-time indicator. The fields on the right that I have highlighted in blue here are just for my notes, for me that I'm preparing this spreadsheet for upload, and I'm just putting notes on the employee so I can kind of remember quickly what type of an employee or what group this employee belongs in, and thus the rules that apply to that employee. So you can see I've got salary, I've got 30 average hours with no insurance deduction, and then 30 average hours with employees that have an insurance deduction. So what I want to show you now is basically how to go back to the FMS average hours report in Excel and kind of filter it to get this data. So essentially the ultimate goal, what we're looking for here, is a list of employees and the codes, of course. I'm doing this by month. There's a lot of different ways. Using a month range like we have here, begin month and end month, it really opens it up to a lot of different ways in order for you to format or generate, let's say, this spreadsheet. Some clients may have already started to do it using a different method, and that's fine. You don't have to use the method that I'm going to show you here, but this is one that we found works best, works for a lot of different clients and a lot of different scenarios. So that's why we're doing it. Although if you have a better method, by all means, go ahead and use it in order to get the data to populate these fields. So let me show you what we're doing here. So what we're starting with as a starting point, you have to start somewhere, of course, is obviously the beginning of the year, January 1st, 2015. And to do that, what I did was going back to my 2014 data, I can very quickly filter out anyone that was termed, again, we did this before, prior to, in prior years, so that I should be looking at only active employees that were active as of January 1st, 2015, okay? And so that's what I'm left with here when I do the termination date filter. Now, the first thing I'm going to do with these employees, so I've got, of course, this is part-time, full-time, salary, and hourly employees. The first thing I'm going to do is look for an hourly rate of 0. In this example, I can do that very easily to find my salaried employees. Now, I also have this particular employee didn't work any pay period, so I'm going to filter them out as well. So this would obviously be a rule where I'm assuming that this rule applies to all salaried employees, that I'm going to say, okay, I know that all of my salaried employees have health insurance, or I can look here on the right, and because everyone essentially in this total insurance column, this is the deductions that were taken during the reporting period, I can see that all of these employees have had insurance, okay? And so what I can do is just essentially take this list of employee numbers and copy it over here into my January upload. And then I labeled them salaried employee. And the rules for the salaried employee is they're getting an offer, and the offer that I'm providing is a qualifying offer, so that translates to IRS code 1A. And they're enrolled in the coverage because all of them had those insurance deductions. So that translates to line 16 of 2C. They're enrolled in coverage. And I know that, again, because they're salaried, they're full-time, okay? So the begin month and end month are both January because I'm doing this by month, okay? And I'll explain why in a little bit when we go to February. And so I do the same thing now for hourly employees. So the first thing I want to do is let me clear the hourly rate filter that I have. I want to keep the term date filter. I still want to only work with employees that were a starting point active as of January 1st. But now I'm going to filter out the 0, okay, to just work with hourly employees. And I'm going to start with an average hours greater than 30. Okay, because I know that these employees had to get an offer. Okay, and going back to my January, I'm going to look at 30 hourly employees that are averaging 30 or more that have no insurance deduction. So I can go back to this insurance, my total insurance, and filter out the zeros. So now I have employees, excuse me, the other way around. I want to filter those that only have a 0, that have no insurance deduction. So these are the employees that did not enroll in coverage, that I had to have given them an offer because they were more than 30 average hours, but they did not enroll in the coverage because they have no insurance deduction over here. So I can take this list of employee numbers and I can paste it into my January spreadsheet, and then I'm going to make a note for myself, 30 average hours, no insurance deduction. And then we can do the same thing in reverse with employees that have the insurance deduction. So I can come over here and just change that filter instead of the zeros to anyone that doesn't have a 0. Okay, and so basically I'm building these groups of employees because I have rules already determined as to each group, essentially what 14, 15, and 16 in the full-time indicator codes I need to apply to these groups. So this is my starting point. Essentially, everyone that was active as of January 1st, you know, this is where I was at to start with. Where the power of this method comes into play is from here on out, I'm really only concerned with employees in transition. And by that, I mean new hires and terminations. Really, those are the two rudimentary transitions. However, you also have IRS, you know, transitions with, for example, employees that are in their measurement period. So you've got new hires going into their measurement period and new hires coming out of their measurement period. And the reason I say that is because there is a line 16 safe harbor code for the employees in a measurement period. That is code 2D. So if your waiting period, measurement period for new hires is 30, 60, 90 days, for the months in which that covers, you will put a line 16 of 2D. So technically we have 3 transitions. We have a new hire going into the waiting period, a new hire coming out of the waiting period, and then a termination. And so what I can do, because I started, this is only my starting point, the first thing that I can do, just to go to the bottom of the list, is I can add the new hires in January. So if I run the report for January, and I can essentially just filter for anyone that was hired in January of 2015. I got a little extra data here at the bottom, but So these are all my employees that were hired in January of 2015, and I can look at their average hours, obviously, to look to see if any of them were over 30 during the measurement period, and none of them are. So technically, I don't need to worry about any of these employees because they didn't, during the measurement period, they're not over the 30 hours. So during the stability period, they're not going to get an offer of coverage. But if there were, I can just add them, going back to my January upload spreadsheet, I can add them in here. And I also have hire date and term dates, again, just for reference or notes. These fields in blue, again, would be deleted when I email it over or save a copy without those columns when I email it over to the accountant for upload. They're not required for the upload. But going back, so I would essentially add the employees in here for January. And then all I have to do in order to go to February is just copy this entire spreadsheet, create a February version. Oops, let me try that again. So I would just copy all of this data and just paste it over into January. So now I'm starting February, paste it into February. I'm starting February 1st. So now I'm just going to change my begin and end month, and I'm going to drop these values down. And so now I'm working with February. And now I need to just look for those 3 transition employees during the month of February. So essentially anyone that was hired, let's say I have a 30-day waiting period, and an employee was hired January 1st, that would be the entire month of January that they were that they're in the waiting period. Thus, February, they're now getting an offer of coverage if they hit the 30 hours. So from here, I can find those employees using my February raw data. Again, the average hours report, just run for February. I can go back and look at employees that were hired in January. Again, test those hours, and then go back to my February upload and look at those employees and update their codes here. So again, we've got employees that we can look at the average hours report and find the employees that are newly hired going into the waiting period, newly hired coming out of the waiting period. So again, for February or March, maybe I'm looking for employees that were hired in January or February. That's kind of my look back period for the measurement. I'm finding the employees that are coming out of the transition period, the measurement period, I should say. And then, obviously, I want to look for any employees that were terminated during the month. So there's a box, there's a line 16 code. I think 2B is the code that needs to be put into place for employees that were terminated during the month. And then, of course, for months after that, you would use 2A, the employee is not employed during the month. There's no offer of coverage because the employee is not employed. So what we're doing here is we've got a starting point, and then we're taking this and we're adding in the transitions, adjusting the employees, adding employees as we needed. And after they're added, they'll just retain on there every month. Now, employees that maybe started in the beginning of the month, in the beginning of the year, we obviously, for months prior, and I should say spreadsheets prior, we don't have them included. Now, we can go back if we need to. However, I can tell you that the 1095, the version of the 1095, our printing program is going to, will backfill the codes for employees if they were, let's say they were hired in June in the middle of the year, and therefore we don't have offer and coverage records prior to that. We will default it to line 14, 1H, no offer, and line 16, 2A, the employee was not employed. So it's up to you. If you need anything other than that, you can go back and fill those employees in for those prior months. But the FMS printing program will also do that for you. So you don't necessarily need to go back to prior months and fill that data in if the employee started in the middle of the month. So I'll just continue this routine for every month during the year. So we highly recommend that you begin this process now. You don't want to wait until the end of the year to start doing this and start calculating, the entire year's worth of data. You can obviously start right now with January to determine who got an offer in January and what was the offer. Okay, so you definitely want to start and get familiar with this. So again, this is one method, one way to do it. There's obviously ways that you can just look back the entire year. At the end of the year, look back the entire year and say, okay, these are the employees that were over 30, so they got an offer for the entire year. I'll just do one record with a begin month of 1, end month of 12, and the offer that they got, and just load them once. This is essentially loading, for every employee, it's loading 12 records. So back on the offer and coverage screen, we have 12 records here. Let me talk about the covered individuals very quickly. There's also a spreadsheet import for the covered individuals. Let me just pause my screen so I can pull up that information. Oops. Covered individuals should most likely come from your health insurance reporting. Again, this is only required for clients that are self-insured. So you're kind of self-funded. You're administrating the plan yourself as far as administration goes, really. Somewhere, obviously, you've got a list of the covered individuals on the plan. So this data shouldn't necessarily need to be calculated. You should already have this. Very simple spreadsheet import here, similar to the other one where we've got the client number, the year, employee number, the covered individual's social security number, covered individual's last name, covered individual's first name, middle initial, covered individual's date of birth, and then the months in which they were covered. Just a simple yes, no, one for each month. Were they covered, yes or no? And that, if I go back to the 1095, translates exactly the same down to this data here, and it will print down under this box. We'll check this box here that they're self-insured, their employer's providing self-insured coverage, and then we'll print the information, the covered individuals for this employee down here into this box. And then, of course, you can also key it in if you need to, so you can just highlight an employee, go to work with covered individuals, and here it lists the individuals. I can either edit or I can add new ones, and then it's just very simple social security number, last name, first name, date of birth, and then the months in which they were covered. So again, this can either be keyed in or you can format a spreadsheet like this. We will provide, everyone that was on the webinar will provide templates for both of these spreadsheets as well as the PowerPoint presentation that Bonnie was reviewing so that you have that information. Let's talk about step 6 real quick, Bonnie.
Step 6 is just filing the forms with the IRS. So you could probably talk about that more than we could.
Yeah. Step 6 is the electronic filing. FMS will generate the electronic file and provide it to the clients. The clients will need to go to the IRS website and upload the file. It's not necessarily going to be like the electronic filing for W-2s where FMS sends it to the IRS for you, the Social Security Administration. This is going to be a little bit different where we can generate the file for you, but the clients will be responsible to get it to the IRS. We will securely and send it to you. You will receive it and send it up to the IRS using their website. We just recently got final instructions on the electronic filing, so we're currently in development of the electronic file, the programs that generate the electronic file. So I can't speak too much on it, but it is part of the FMS reporting module that we will generate along with the paper forms the electronic file that goes to the IRS. Employers with 250 or more forms, yeah, must be electronic. So we'll have that for you also. Okay, so that wraps it up. Bonnie, do you have any final thoughts?
Can you pull this one back up?
Yeah, that slide? Sure.
I just wanted to recap this real quickly. Step one was determining whether you are an ALE. If you have not done that, please do that very soon. If that determines pretty much everything, all these other steps. If you are an ALE and you want to provide coverage, it should have actually been offered to your employees as of January 1st of 2015 for the 15 tax year reporting. There is quite a bit of relief that the IRS is giving to employers, but they are not relieving your filing requirements. So if you are over 50 full-time employees, you must file these 1095-C returns to the employees. Please start filling out those forms either online or on the spreadsheet so we can start getting that information into the system before year-end hits.
Yeah, we really only, after the end of the year, we really only have a month to get everything for every client, all the data for every client in and print the forms. It's going to be a lot of work. You definitely want to start now. One of the final thoughts, regarding that is contact your accountant to get the Excel form, and you can ping questions off of them if you have questions on anything that we talked about here. All the FMS staff is trained to help you, assist you in getting the data into our system. Otherwise, Chris Cooley over at My HR Concierge, I hope that you've listened to some of his webinars that we've done. We've partnered with My HR Concierge. They do a number of things for independent grocers, not only the Affordable Care Act compliance, but other HR services, employee screening. But Chris Cooley's an expert in a lot of the ACA compliance. He can definitely assist you with questions related to, okay, which of the codes do I need to use? And he gets down more into the nitty-gritty of how exactly or what exactly you need to put on these forms, because again, the FMS module is really just we're going to report whatever data we've received. So again, we'll send out this PowerPoint presentation and all the materials that we showed you here. We'll email out to all the participants. But as we said, go ahead and get started now, because we definitely don't want to wait until the end of the year to do all this. I hope that this presentation was helpful for you. I'm sure we'll have some others in the future going forward, but we want to thank everyone for joining us. Thank you and have a nice day.